Thinking about investing but not sure where to start? What if you could build a portfolio that grows over time, survives market crashes, and even pays you along the way using just 4 ETFs? In this video, we'll cover 4 ETFs that you should seriously consider investing in 2026, and one of them might surprise you. Hi, and welcome to the Smart Money Project. On this channel, we break down personal finance in a simple way. If you already invest, you know that ETFs, short for exchange-traded funds, are baskets of stocks, bonds, commodities that trade like a single stock. They let you invest in hundreds of companies at once without buying them individually, which is exactly why they're so popular. There are thousands of ETFs out there, covering different regions, strategies, different asset classes, and that's where most investors get stuck. Choosing the right ones can feel overwhelming. And that's why I'm breaking down 4 ETFs that you should seriously consider investing in this year. If you believe that the biggest winner of the next decade will still come from the US, JP Morgan Momentum Factor is the right fund for you. JMOM invests in fast-growing US companies. Think of names like Nvidia, Apple, Netflix, and many others. While this isn't the type of fund that's going to explode overnight, it has shown impressive performance in the long run. Over the past 5 years alone, the fund has returned 80%. Another excellent perk is the low expense ratio, sitting at just 0.12%, meaning that you get to keep most of the money you make. Another benefit is 1% dividend yield, which is modest, but it still provides some income during the times of market downturn. While the fund is slightly overvalued right now, like most American stocks, it still presents an excellent long-term investment. If you believe in American innovation and companies, and if you believe America is going to continue to dominate and define the next decade, this fund definitely deserves a place in your portfolio. When markets crash, Vanguard Value Index is the one you definitely want to have in your portfolio. This is another US-based ETF, but unlike JMON, it focuses on value-driven companies. Think about names like Walmart, ExxonMobil, Costco, Home Depot. These companies have real assets, real cash flow, and proven track record, which makes them much more stable during market crises. With this ETF, you can expect slower growth than JMON, but a lot more stability, especially during market crashes and downturns. The expense ratio is extremely low, sitting at 0.07%, which means you get to keep most of your money, and the fund is fairly priced, making it one of the very few US-based ETFs that's not overvalued. For investors looking to profit with stability, this fund is a core holding that will keep your money safe during market downturns. This third ETF fixes one of the most common mistakes that US investors make, without even realizing it. VGK, or Vanguard Equity Index Europe, tracks the value of the European companies, which gives you exposure beyond just the US. One of the biggest benefits of this fund is that the European companies are still relatively undervalued compared to their US counterparts, making this fund relatively cheap to buy. At the same time, you'll still be exposed to major, well-known companies with global reach and proven track record. Think about names like Nestle, Shell, or Louis Vuitton. Another big perk is a high dividend yield. This fund returns 2.88% dividends, which provides a strong income while holding these stocks. VGK adds value, income, and international diversification to your portfolio, and that makes it an excellent addition and an excellent complement to the other US-based stocks. The final ETF on this list is completely different from the others. This ETF is not here to make you rich, but without it, you might lose all your money. iShares Gold Trust, or IAU, is a commodity-based ETF that buys, stores, and tracks the value of gold. Gold has been on a long-term rise over the past several years, and this trend is generally expected to continue. I even made a video about this that you can view here. But more importantly, IAU will hold its value when markets struggle, which makes it an effective hedge. This ETF is not designed to outperform the market and other ETFs, nor does it pay dividends. Think of it more as an insurance to your portfolio. It adds balance, it reduces volatility, and even a small allocation to this ETF can make your entire portfolio much more resilient to market crashes. So there you have it, 4 ETFs to buy in 2026. JMON for growth, VOV for stability and value, VGK for international diversification, and IAU for balance and protection. Together, These ETFs cover multiple strategies and asset classes, helping you invest smarter and think long term. Remember, holding quality investments over time always beats chasing trends. If you found this helpful, hit that like button, subscribe for more investing insights, and let me know which ETF you would want to learn more about next.